Good afternoon, everyone, and thank you so much for joining us for this Green Bonds 101 webinar. My name is Nicole Harmon. I'm a program manager with the Intentional Endowments Network, and I'm very pleased to have with me 5 great panelists to share their experiences and expertise on this topic. During this webinar, we'll be hearing from Chris Wigley, Senior Fixed Income Portfolio Manager at Mirova, Elizabeth Palchack, a graduate fellow at the University of Vermont and a member of the university's Socially Responsible Investment Advisory Committee, David Ellis, Executive Vice President and CFO at Becker College, Kevin Kwok, Vice President of ESG Fixed Income at MSCI, and Dominic Pappalardo, Portfolio Manager at McDonnell Investment Management. After our panelists' presentations, we'll spend the remainder of the hour in dialogue responding to your questions. So please enter them throughout the presentation in the chat function of the control panel at any time, and we'll try to get to as many of them as possible. This webinar is being recorded and will be distributed to all registrants by email, and will also be available on our website shortly after it's completed, so you can refer back to this conversation and share it with others. And we will also make the slides available upon request. So just briefly before we dive in, for those of you that aren't familiar with the Intentional Endowments Network, we're a nonprofit, collaborative peer learning network with the goal of supporting endowments and enhancing performance by aligning investments with institutional mission, values, and sustainability goals. We do this in a variety of ways, including hosting in-person forums and events, facilitating peer networking, curating useful resources on sustainable investing opportunities, and providing educational venues such as webinars like this one. We encourage you to stay engaged in these conversations after today's webinar. More information on IEN is available on our website, intentionalendowments.org, and you're welcome to reach out to us at any time. So with that, I will turn it over to Chris Wigley. And Chris, before you dive into your presentation on the green bond market, would you mind sharing a bit of background on the story of how you got involved with green bonds?
Certainly. So thank you very much, Nicole, and good afternoon, everyone. It's very good to speak to you. Just to give you an introduction as to how I got involved. I've been a fixed income portfolio manager for 30 years or so, and prior to joining Mirova, I worked in London, and this was the start of the green bond market in 2006. And there was a social bond that was issued, and it was financing vaccines in Africa overseen by the Bill and Melinda Gates Foundation. And this was the first time that a bond disclosed how the money was going to be used. And this really struck a chord with investors. And this template was then used for the green bond market. And then the green bond market really took off, particularly over the last 6 or 7 years. And I hope to go through that in the slide presentation. Just to introduce Mirova to you, just over the next few seconds, Mirova is an affiliate of the Natixis Investment Management Group, and Mirova is a specialist in responsible investing, and that is all we do. So I manage 3 global green bond funds here, and as I say, I've been privileged to be involved in the green bond market for many years. If we could move to the next slide, please. I want to define what a green bond is, but before I do that, I would like to say who is defining the green bond. And this really relates to the green bond principles. And so it was realized a few years ago that that issuers needed some guidance as to how a green bond should be structured. And so the green bond principles were set up. And this represents the whole industry. It represents issuers, investors, and intermediary banks. And Mirova is privileged enough to be a member of the executive committee. And the executive committee is divided 3 ways, issuers, investors, and intermediary banks. And to give you an idea of the sorts of participants, the investors include, of course, Mirova and also Zurich Insurance, for example. Issuers include the World Bank and IFC, European Investment Bank, Nordic Investment Bank, corporates like EDF. And the intermediary banks include the likes of JP Morgan, Merrill Lynch, Crédit Agricole, and others. So you can see it represents the whole industry and globally. And they produce the green bond principles each year to give guidance to the market. So if we could just move to the next slide, please. So here we have the definition. This definition came from the Green Bond Principles in 2016. And essentially the Green Bond Principles said that a green bond is consistent with the 4 pillars of the Green Bond Principles. Now I won't go through every one, but pillars 1 and 4 are the most important. So the first is the disclosure of identifiable use of proceeds. This is very important for us as investors because we have investors in our funds who want their money to go to green projects. However, any issuer can issue a green bond and claim that it is green and then use the money for other purposes such as share buybacks or debt financing. So it's very important that the issuer discloses the use of proceeds. And it's normally renewable energy, energy efficiency, green transportation, biodiversity, water sustainability, etc. The other key element that I'd like to identify is the 4th pillar, and that is regular reporting. So this is something additional that issuers of green bonds do, that issuers of conventional bonds do not do. And so this is on a regular basis, normally annually, the issuer will release an annual report. Initially, it was a newsletter that disclosed information to investors on the disbursement of funds to projects. But increasingly, it's become an impact report. So investors have been asking questions about the strengths of the projects that they're being invested in. And so the issuer is releasing more information with regards to greenhouse gases reduced, for example. Now, before I move on, I just want to highlight one thing, and that is with regards to green bonds, they also produce a market return. Green bonds, as I've highlighted, do provide something additional that conventional bonds do not, the disclosure of the use of proceeds and the impact reporting. And some may think that the investor has to pay more for this, but we do not think so, because the issues of green bonds, of course, often have credit ratings, and those credit ratings are often the same as the credit ratings for a conventional bond from the same issuer. And that's because the credit risk is the same. It's often the balance sheet of the issuer. And we say that if the credit risk is the same, then the return should be the same. And the market has followed this. And so when an underwriting bank prices a green bond, they will normally price it flat to the conventional bond from the same issuer. So that's important for investors to know. They shouldn't be paying a premium for green bonds at all. So there may be benefits for investors, but there are benefits for issuers too. And the benefits for issuers are, for example, diversifying their investor base and also to send a strong signal to the market that they are sustainable. So if we could move on to the next slide, please. And sorry, the slide after that also. I won't dwell on every slide. Okay, thank you very much. So this is a snapshot of the market, and it shows how the market has grown. And I mentioned at the beginning I was privileged enough to be involved in the market at the beginning. See on the left-hand side the graph that shows the market was a very small market in the early days, from 2006. The first green bond was actually issued by the European Investment Bank in 2007. And it was a quiet market for the first few years. It was dominated by supranational banks like the EIB and the World Bank. And so they tended to be AAA, and the maturities tended to be short, up to 5 years. And then we saw significant growth in the market from 2012 onwards. And this really coincided with the financial crisis, and issuers wanted to diversify their investor base. We had the first issues that were more than $1 billion or euros in size. The first $1 billion issue came from the IFC. But the first €1 billion issue came from corporates such as EDF and ENGIE in France. And you can see how the size of the market has increased. Now here we have data as of the end of March this year, but the data as of July says to us that the size of the market now is in excess of $284 billion equivalent. So you can see it's growing significantly each year. And if we look at the graph on the right-hand side, we can see the annual issuance. And again, you can see how that has grown significantly from 2012 onwards. Each year, the issuance has exceeded the previous year's issuance. And you can see we had a very strong year in 2017. 2018 doesn't look quite so high, but that's data up to the end of March. Data up to the end of July states that issuance this year, we believe, is in the region of $59 billion equivalent. So that's more than half the figure of 2017. So we are on track for exceeding the 2017 figure again. And just to give you a flavor of some of the issues we've seen this year, for example, at the beginning of the year, the European Investment Bank, they've issued in multi-currencies. They've issued in US dollars, euros, Canadian dollars, Australian dollars. Similarly, another supranational bank like Nordic Investment Bank have issued in euros. Provinces like the provinces of Quebec and Ontario, they've issued in Canadian dollars. This year we saw significant issuance from sovereigns. So the largest green bond out there is the French Green OAT, which is 14 billion euros in size. So that's greatly helped liquidity in the market. But other sovereigns have come to the market too, such as Belgium, Indonesia, and Poland have issued 2 green bonds to date. So sovereigns are actually following up on the Paris Agreement. They've committed to keep global warming to +2 degrees or less, and issuing green bonds, it's transpired, is one of the ways they're doing that. But also corporates are a significant issue as well. For example, ABN AMRO of Holland, Berliner Hupp of Germany, Tenet, the Dutch utility, Iberdrola, the Spanish utility, Enel, the Italian utility, and Scottish and Southern from the UK. They've all issued green bonds this year, and they are repeat issuers. So there's more than one green bond in the market from them. But we've also seen first-time issuers come to the market, such as Mitsubishi UFJ of Japan, KBC Bank of Belgium, Svenska Handelsbanken, and the Swedish bank too. So there's a whole variety of issues in a variety of currencies and a variety of asset classes, and we'll come on to that next. So if we can move on to the next slide, please. So this is the profile of the market, and I won't spend much longer on this, but just to let you know that on the left-hand side, we've got a breakdown of the market by currency. So you can see that the euro is dominant at the moment. It's about 56% of the market, and US dollars is about 34% of the market. The leadership has changed in the last couple of years. The US dollars used to be the largest currency, particularly with issuance from emerging markets. Issuers in Brazil, Mexico, India, Korea, etc., will often issue in US dollars. But with the issuance from sovereigns such as France and Belgium and issuance from European corporates, the amount of issuance in euros has significantly increased. And there are other currencies there as well, such as sterling, Australian dollars, Canadian dollars, and Swedish krona. In the middle graphic, you can see how the breakdown of the market by subclass. You can see that corporates are dominant at 29%, but also the supranationals and agencies are significant at about 15 and 14% each, and also banks as well. High yield is relatively small, it's only about 3%, and then you can see the bottom sovereigns are a smaller part of the market, but they're growing significantly, and they're at 9%. And on the right-hand side, we can see a breakdown by credit rating. And because of the significant issues from supranational banks and agencies, AAA is significant, and so you tend to have higher credit quality here than 100% corporate bond funds, for example. And then I'll just finish off by moving to the next slide. And this is the final slide that I'm going to talk about. And this is just a breakdown by country. And here you can see that we believe that France is the largest issuer of green bonds. Of course, it's the Republic of France, the sovereign, but also other significant issuers in France, such as the corporates, such as Unibail, EDF, NG, banks such as BNP, BPCE as well, and agencies like the rail agency, SNCF. Then we have the supranationals. The Holland is another country very committed to the green bond market. We've seen significant issuance there, such as Tenet, the Dutch utility, ABN AMRO, ING, and Rabobank, the Dutch banks. plus Alliander, another Dutch utility as well as agencies such as the Dutch Water Bank too. Germany's been a significant issuer. KfW is a large AAA agency there, but also Berliner Hut, the mortgage bank, and Energy, the German utility, they've issued green bonds. And then we have the United States, and significant issuers there have included Apple. They've issued 2 green bonds, plus Southern Power have issued a variety of green bonds in dollars, but also in euros as well. And a recent entrant has been Fannie Mae as well. And very recently, the Fannie Mae issues have been consistent with the green bond principles. Spain's a significant issuer, particularly the utilities. Australia, the Australian banks. It's very reassuring to see the interest out of Japan. We've had significant issuance there from the Japanese banks. And just today, we had a Japanese bank come in to roadshow with us. We're seeing a lot of roadshows at the moment, so we're expecting more issues in the pipeline. India is a significant issuer, particularly the state railway there and the agencies, and also Italy as well, primarily the utilities in Italy as well. So you've got a whole range, and what's attractive about the green bond market is the diversification by currency, the diversification by subclass, the diversification by sector, and the diversification by issuer as well. I'm sure you'll hear more about this later on, but in the Bloomberg Barclays Green Bond Index, for example, there are more than 240 issuers in that index. So there are significant diversification opportunities there. And at that point, I'll leave it there by way of introduction.
Great. Thank you so much for that presentation, Chris. And I'd now like to turn it over to Kevin, the Vice President of ESG Fixed Income at MSCI, who will be building off of Chris's presentation by sharing more information on how the market is evolving and why endowments should invest in green bonds.
Thank you, Nicole, and thank you, Chris, for the thorough Green Bond 101 presentation. So next slide. Okay, so we'll be talking about today is how is the green bond market evolving, and also why invest in green bonds. All right, next slide. So there is a need for transformative investments. There is a huge funding gap at this moment. If you look on the left, there's a 2100 warming projections, and we need about 29 trillion in additional clean energy investments to meet the 2-degree target between 2015 to 2050. That's with the Paris Agreement. Next slide. So I'm going to be talking, Chris already talked about the green bond principles, so I won't repeat a lot of that, but I wanted to talk about the green bond index at MSCI that we partner with Bloomberg Barclays. So just a breakdown of the funding of each environmental category based on market value, you can kind of see that the 2 largest categories are alternative energy and energy efficiency. There's a huge overlap kind of with each single bond. You may see it contributes to different multiple categories. Our green bond index right now is about 227 billion and it has about 264 securities inside. But last year it was just barely approaching 200 billion. So you can kind of see just the breakdown, how everyone has been always focusing on the alternative energy and energy efficiency, but then there has been some kind of categories that also contribute to green buildings, sustainable water, pollution prevention, and even things like climate change adaptation projects and sustainable forestry. Next slide. So I think Chris already kind of went over this, kind of the growth of green bonds, but basing it off of the Bloomberg Barclays MSCI Green Bond Index, you can see the global index is kind of reaching above 200 million this year. But then when you look at the corporate breakdown in the yellow-orange, the orangish yellow, you can see that it's really only about half. So most of the issuance is coming from the governments, the sovereigns, and kind of the municipalities. Next slide. And this is also a composition of our green bond market based off of our index. It's a mouthful, sorry. Bloomberg Barclays MSCI Global Green Bond Index. But the difference with our index is we do add our own criteria where we are only investing in investment grade. So what do we consider investment grade? We take the average rating of S&P, Moody's, and Fitch, and that's how we derive our rating or credit quality. And similar to what Chris was saying, even our index, it's comprised about, mainly governments, and so that's treasuries, sovereigns, supranationals, agencies, and some local authorities. And then you can see the 32% is corporates, and then some really small portion is securitized. Next slide. Okay, so this is kind of our MSCI ESG ratings versus our green bonds. So a lot of people think they may be the same thing, but really the evaluation of green bonds is independent of our issue or ESG rating. At MSCI, we rate over 6,500 individual companies, and also when you talk about the fixed income market, we probably rate about 600,000 securities that are tied to these issuers. And on average, green bond issuers tend to have stronger ESG profiles than their peers, but even the lowest rated companies can issue green bonds to finance improvements. And when we talk about ESG, we talk about environmental, social governance risks, and it's really how the companies manage the risks. So when you look at the chart on the bottom, we have the distribution kind of the global green bond index versus the Bloomberg Barclays global aggregate. We have, for our green bond index, we have 40% that are considered ESG leaders or within the AAA, AA category of our ESG ratings compared to 15% of the global aggregate. So what we're saying here is we believe that the issuers in the green bond index, are the 40% leaders, are better at managing their ESG risks. Next slide. And here's a case study that that was done with the U.S. corporate bonds done by Barclays using our MSCI ESG ratings. This is also very important within fixed income. One of the things that was found was looking at E, the S, and the G pillar. Governance was assessed to be the most important of them all. So when it comes to the bonds, just looking at the regular U.S. corporate bond index from Barclays, Bloomberg Barclays, you'll see that bonds with high MSCI governance scores tend to experience fewer credit downgrades. So that's significant when you start thinking about risk factors and long-term resiliency when it comes to ESG analysis and fundamental credit analysis. Next slide. So green bond market trends. Some of the trends that we're seeing is really hot in Asia at this point, especially emerging markets. And one thing to note is that there are some differences in the way we look at green bonds compared to maybe like a China. There's some gray areas where, globally, maybe some people think hydropower is considered green, but in our eyes, we try to limit our hydropower to maybe a size of 25 megawatts, because we start thinking about biodiversity and land issues at this point, and also China may look at clean coal as green, as considered green, but we may not think the same thing as well. And then we see continued innovation. So we also see more of a focus on securitized green bonds these days, and also sovereign green bonds. And we looked earlier that a lot of the green bonds right now within the government are supranational and agency type green bonds, and sovereigns are really moving up. Next slide. So why invest in green bonds? Okay, next slide. Well, So there's a lot of challenges with green bonds right now. Green bonds are really, they have a standard, the green bond standards are very voluntary at this point. They require consistent and independent assessment. So we follow up a lot with these funds. And typically we have what we call kind of a green bond watch. If we don't receive the proper information within 90 days, we put them on watch. And then within 6 months, if we still don't receive the proper information without a credible reason, then we would pull them off of our index. And the green bond market is still very small, but like as Chris was saying, it is growing right now. And also with the 2-degree initiative, you know, there's a lot of money to be funded. And also there's challenges in accessibility and liquidity, and then there's a huge role for green bonds. Next slide. So should you invest in green bonds? So right now, when we look at kind of like the green bond index versus the regular Bloomberg Barclays Global Ag, the risk profile and the return profile are very similar. So really in the end, what we've been seeing with people is they use this green bond as more of a positive impact. And for example, you see the World Bank, they came out with a green bond impact report, and they start talking about kind of showing key metrics, where are the annual energy savings, the energy produced from renewable resources, and also what is the capacity of the renewable resources. And also, when we talk about green bonds and relating to kind of like the universities, we see a lot of universities raising finance through green bonds, primarily for purposes of green buildings. And some examples are like MIT and University of Cincinnati, Ohio, among others. And we have been seeing a lot of the issuers calculating carbon reductions and what emissions they have avoided from green bonds. And when it comes to kind of like thinking about global impact versus community impact, a number of projects funded through green bonds by the supranationals, government, and municipals, you know, they really do benefit the local communities by looking at water efficiency, public transport, climate adaptation. So these all have positive impacts on the local community. So that's it for me. Back to you, Nicole.
Great, thank you, Kevin. And now that we've covered the value proposition for why one should invest in green bonds, I'm excited to hear about the University of Vermont's journey towards sustainable investing and green bonds from Elizabeth Palchack, who is currently serving as Interim Sustainable Funds Coordinator at the university. So take it away, Elizabeth.
Hi, everyone. It's good to be here. I primarily am a consultant at an organization called VEIC, and have stepped in to cover the role of this coordinating role. It's a new position at the University of Vermont that is what my graduate fellowship turned into. So we're in a bit of a transition for that role, but I've been doing this kind of work at UVM for about 5 years. Next slide. VEIC, very briefly, is a think tank, and we are addressing a changing energy landscape and reducing greenhouse gas emissions in many ways, creating programs. My expertise is in behavior change, and part of that we see is supporting universities and colleges in their sustainability goals and sustainability efforts. Next slide. Part of the way I got into this work is that I've done research on millennials and how they are shifting both the energy landscape, but also investing trends. This is a really interesting area of research, and what we see is that the millennial generation, I think David's going to touch on this too, is asking for a lot more with their investments. So we're seeing them push for, of course, fossil fuel investment, divestment. They're also very interested in positive investments and have really started to shift the investing landscape. Next slide. So this is just a layout of the work that's happening at VEIC and where my focus areas are and how that intersects with the things that I did at the University of Vermont and still do as an academic. Next slide. I am the staff person that is supporting the Socially Responsible Investing Advisory Council at UVM. And this is a group that is comprised of our controller, our assistant controller, the coordinator position, which is mine, and then we have representatives from, 2 representatives from undergraduates, graduates, staff, and faculty. This group makes recommendations to the Vice President for Finance, and then he moves them up through the organizational hierarchy to the Board of Trustees. Next slide. We came to the green bonds conversation because of really divestment, which was a robust conversation on this campus back in 2013. We had a very active movement and very active protests against UVM's investments in the fossil fuel industry, of the endowment, but our Board of Trustees rejected calls for divestment and then subsequently rejected calls for coal divestment. And those were both recommendations with a lot of caveats that came from the Socially Responsible Investing Advisory Council. And so this group of people, students, staff, faculty, were starting to feel honestly a little frustrated and not sure where to go next. So we turned our attention to essentially positive investments, which in my experience, students know much less about, so there's a huge educational necessity, but can be very exciting and has been exciting for our SRI Advisory Council. Next slide. So this is how we did it. And I'm going to go through this pretty briefly in the interest of time, and then I need to go to another meeting that I'm running, but please reach out if this is of interest, because this stuff is very political and very complicated at universities, and I think we can all learn a lot from each other. So we shifted from green bonds, positive investments, and away from divestment. We weren't getting anywhere with our Board of Trustees, so we reframed the conversation, basically. And then the other thing, this was an idea that came from our VP for Finance, who is broadly, I think, quite supportive of the work that the SRIAC does. And he said, you know, I think we also need to spend some time shifting our focus away from the endowment, which, you know, I'm not saying that that's the path for everyone, but he essentially gave the SRI Advisory Council a bucket of $10 million that's from our operating funds. And he said, let's think about positive investments. The operating funds are administered just by the VP for Finance. So at least for now, it kind of takes it out of the realm of the Board of Trustees. There's a little bit more control, and we can kind of work with this smaller amount of money to see what we can do with it. So as we did a bunch of research, we found out that green bonds was a logical way to go. I reached out to Mirova, but we were really impressed with their approach. It's very rigorous. And we ended up talking to about 5 different firms through webinars and educational opportunities for our Investment Advisory Council, because green bonds, as has been touched on a couple times, is this really new space that pretty much everybody, aside from maybe investment managers, are having trouble getting their heads around. So we really, we had a finance faculty person on our SRIC. He was instrumental in helping kind of bring us along. And then my job was to just get us in touch with anybody that could get us further along this learning curve. So we had lots of conversations. We were reading articles out of the New York Times that covered green bonds. And then finally, we aligned our efforts with the ASHE STARS framework, which I'm sure many of you are familiar with, the Association for the Advancement of Sustainability in Higher Education. So we've been using them as a resource, looking at the actual STARS framework to see how we might move forward with green bonds. We put forth a recommendation to our VP for finance that he has approved. We did this in the spring. And we moved forward with a manager that has experience with college students and will be able to do even some more teaching with our business school. And our finance faculty proposed a business course to take this new, these new investments in green bonds and use students to analyze and do some of the sort of secondary analysis, or primary or secondary. I mean, ultimately, it'll be our investment managers that make a lot of the decisions, and ultimately, it's our VP for finance. But there's a really nice kind of dovetailing that's happening here as we move into this new investing space. We're going to get students on board to learn about it as sort of a real, you know, an experiential educational opportunity that's, I think, pretty innovative. So on the right there, you can see kind of our process and how we thought about this. It was messy, and I think a lot of them are. It's a kind of a big, complicated thing when you're working with people who are not finance professionals, who are students in, you know, environmental science, or in, you know, what else? Our other student is in, well, he's economics, but still, these are not finance professionals. We have a physical plant person who's on the SRI AC. So it took a lot of conversation and a lot of education to move us forward, and it was slow and it was, you know, kind of awkward, but we're there, and we're stepping into this space with a lot of excitement. So that's all I'm gonna cover right now. You can go to the next slide, but again, I'll encourage you to reach out, and the Intentional Endowments Network is obviously an incredible resource, and we use them also. That's all. Thanks.
Fantastic. Thank you so much, Elizabeth, and thank you for joining us between meetings. It's much appreciated. So transitioning now to another endowment case study, I'd like to introduce David Ellis, Becker College's CFO, to discuss the stakeholder engagement process at Becker and what the college has done in their portfolio in relation to ESG investing.
Great. Thank you, Nicole. I've been very fortunate to have been in higher education for a long, long time. I've been just for context, I've been the chief operating officer and the chief financial officer at 4 very different private colleges in Massachusetts. I've worked with a variety of expert and non-expert investment committee members, and I won't identify where, but in one place during one of the financial meltdowns, the investment committee wanted to liquidate all of their equities in the portfolio. So dealt with some interesting situations. I've worked in what will be for most people on this webinar, the magnitude of small numbers. So these are enrollment size institutions, all colleges from 1,000 to 4,000 students. They're certainly not the size of universities, and endowment sizes of only, quote unquote, 160 million down. Our endowment at Becker as a relatively young master's level college is only $6 million, which will demonstrate how our transition may be a lot easier than it was for others. And I would also disclose that I'm not a technical expert. I know enough to know where to go get help. So over the years, I've used resources such as Cambridge Associates, or now, as you can see from the slides, now we have a partnership with HIP Investing and Paul Herman's book from 2010. So Becker's we've got 2,000 students, and just as Elizabeth described, these millennials are very, very different from the students that I worked with in the 80s, 90s, et cetera. They come to us looking for a wide range of accommodations, accoutrements, et cetera, in their classes and in the physical plant, but they come to us talking about sustainability, and they come to us talking about community service, impact on the environment, concerns that they have in this generation. So they are much more active in that sense. We do teach social business, ESG, SRI investing in our business school and business curriculum. So we've made that shift just in the last 3 or 4 years. So if you turn the slide, Nicole, my presentation is a little bit different than my colleagues in that we're talking about the entire pathway to what became 100% investing. As I said, it's an amount of endowment only between 5 and 6 million. But I think many of the issues with our trustees and external parties are probably the same no matter what the scale is, and Elizabeth touched on some of those too. So back in 2015, myself and the former president came upon Paul Herman's book, the HIP, we thought that really synced nicely with our academic programs, and we especially like the HIP measurement system, which looks at beyond just financial results. It looks at who runs the company, what is the gender balance in the company. I think now the statistic is probably safe to say that if you look at the traditional age college students, the percentage of women is somewhere between 65 and 70% in some of our colleges, certainly in smaller colleges. So what are women's leadership opportunities in these corporations? Are they transparent? Do they work in ethical ways? And there's a whole series of other databases that they have access to. So we made the decision in 2016, as you can see here, with the board's unanimous approval. Now, it took 6-7 months back in 2015 to work through the learning curve and some of the questions that I'll throw out at the end for Kevin, Dominic, and Chris touched on one of them too. It then took a year, as you can see, from 16 to work with our investment managers, who are fantastic to work with, but we're a little hesitant at the front end. The endowment is not our money, it's the future of the college's money. But once they saw some of the advantages that the HIP advising system does, they then realized they could change their platform. I'm happy to say they've been able to sell that to many other clients too, as they come to realize. We felt that this system of sustainable investing, it linked nicely with our mission. It links with the core values of the college. We looked at then at some of the financial issues, which I'll throw out at the end, but the board did approve it to make all the formal changes after we had done a full year of analysis. So it took a while to get, probably 14 months to get to January 2017. They approved the changes, and we were able to, because we had been set up to do so, with the exception of one fund, we were 100% invested on July 1, 2017. Now we're spending some time, and thus pertinent to this discussion, is really digging into the funds, particularly the fixed income, which wasn't our first priority. And so I'd have you flip the slide, Nicole. So here's, you can see the 4 impact categories that we looked at within the rating scale, what the goals were for the college. You can see those in the blue. If you have color in the 20, you can see what the 2016 allocation was before HIP. And then you can see the results after at 12/31, and now slightly better. Just didn't have the data for a slide. If you're interested, our asset allocation is 65% equity, 25% fixed income, and 10% for alternatives. So that you can see in the initial work, we were able to reduce fees and start to achieve better ROI across the board. So if you go to the next slide, now you can see these are the 5 funds pertinent to today's topic that are in the fixed income portfolio, and I'm sure many of you have them. You can see the HIP rating, which is what attracts us. We want to be 75 plus if we can be. The financial return is the 5-year cumulative, so that's not annual, that's a cumulative return, and then the expense ratio is on the right. If you flip the next slide, this one's a little hard to read, but if you have a chance later to look at it when it's put up on the web, or if you print it out, you can see across the top, here is an example of CCM fixed income funds, and you can see many of the items in the blue at the top are exactly the types of issues our students are talking about. It's what we're teaching our students in social business. How much are you investing in your communities? Healthcare is a huge issue for all of us going forward, certainly in Worcester and Worcester County. And across the top, many of these issues would get check marks from us. And so it's one example we pulled out to share with everyone in terms of what we're looking at. And then if you go to the last slide on this, this is just an example of a bond that's in the CCM portfolio and the types of details we look at and share with our board. We don't have quite the student involvement that UVM does, as Elizabeth said, but we do with our student government, work with them, and then we are completely transparent for the most part with our business students who are finance students or have more expertise in this area. So that's my last slide. The 3 takeaways, and our colleagues might want to comment on these, which were the roadblocks with many, was how is the return going to be impacted with green portfolios, never mind just green fixed income. There was concern about returns. There was some concern about transitioning the portfolio, albeit a small one. What were the transaction costs going to be? And then there was a learning curve for the board because as Elizabeth said, a great many of our board members do not have the financial expertise, but work in childcare, healthcare, et cetera, so certainly had the sustainability concerns. And then the current issue that we're dealing with, and Chris touched upon this at the beginning, is given, and it was the differential when he was looking at euros and US dollar investments, is we do have some worries here in New England, certainly in Massachusetts, about the Trump administration. We won't go down that one, but with the less priority on the environment, our students are concerned there's less priority for the climate changes. Certainly Kevin had a horrible looking graph there about global warming. And then with the trade regulations impacting green companies, inability to get solar panels, for example, from China, now we're starting to really look at some of the fixed income side of green investing just to best protect the little money that we do have, and to see if there's going to be any shift in the investment world because of that. So with that, I'll turn it back to Nicole.
Thank you so much, David. And for our final presentation, we'll be hearing from Dominic Pappalardo, a portfolio manager at McDonnell Investment Management, who will be discussing the process of transitioning endowment investments to an ESG strategy, and hopefully throughout that responding to some of those roadblocks that David laid out.
Great, thank you, Nicole, and thanks to everybody for connecting in today to hear the presentation. I think it may be helpful just to give a little bit of background on how we've seen this landscape change over the last, I'll say, 2 decades or so from a client management perspective. And McDonnell Investment Management is a fixed income management firm. We focus on traditional institutional clients as well as high net worth individuals. And we operate both in the taxable and tax-exempt bond markets and have strategies on either side of that equation. If you go back about 2 decades, that's probably when we first started hearing questions or requests from clients related to what has now become ESG. And back then, it was really much more of a negative screening process. And what I mean by that is the questions or requests were more along the lines of, don't invest my money in corporations or municipalities that do this, or avoid companies that do that. And the traditional restrictions would focus on things like firearms, alcohol, tobacco, etc., kind of the more obvious exclusions. And 20 years ago, that was a relatively new concept, and certainly mechanisms became available to accomplish that. And for a long time, clients were happy with that and felt like they were accomplishing something by excluding investments in the companies that did, for lack of a better word, bad things, in their opinion. And that has continually evolved over time. And now, as you can gather from the information that's been shared, we've evolved quite far. And now we're to the point where we could break down companies' impacts in a variety of ways. And as you just heard from the previous presenter, we also partner with HIP Investor out of San Francisco and use their ratings and ESG scoring output as one of the key components into our investment decision-making process here for clients that want some sort of ESG focus. It's even gotten to the point now where the information has become so granular and deep that we can offer thematic approaches. So we can have a strategy that focuses on environmental impacts or a strategy that focuses on social impacts. We can also focus on things that are more narrowly defined, like fossil fuels, for example. So because of the data that's become available, the flexibility in the ways to implement an ESG or SRI strategy or filtering process have grown immensely. What's interesting is that many of the roadblocks that have been discussed still come up, and there is always a hesitation, I shouldn't say always, there is often a hesitation to make dramatic changes to an investment policy, particularly when we're talking about something on what is really a public domain space or quasi-governmental institution like a public university. There's certainly different agendas that come into play, and I'm sure many of the participants can relate to those challenges. We've had significant experience with clients that handle this in a variety of ways. I think we've heard how perhaps focusing on operational funds may have been a less resistant path than trying to change the overall endowment IPS. I concur that we've seen that. We also have clients that say, okay, I want to take a portion of my assets or my investment funds and dedicate them to an ESG strategy. And eventually I can increase that percentage to the point where over the long run, I'll get to 100%. But that avoids the risk of kind of the rebalancing, dramatic rebalancing, or even the transactional cost impact discussion. Some people prefer to do it over time. Some people prefer that any new dollars that come into my fund only go towards the ESG mandate. So there's a variety of ways that we've seen people implement it. The big question that is still out there to be answered, and one that I think everybody struggles to provide a clear, concise answer for, is how much different are the returns for an ESG strategy as opposed to, let's say, a traditional core fixed income strategy. And what we found, having running both side by side, is that there really isn't dramatic differences, because in some cases, you can even go as far to say is that the overall portfolio construction doesn't change that much. And while that may sound counterintuitive and a knock against the ESG process, is actually a very positive statement to make, because what that means is the companies that we've been selecting to invest in based on their credit rating or traditional fundamental financial analysis are also showing up well in the ESG screening process. So in some ways, that is actually the ultimate goal of everybody involved in this discussion, is seeing the realization that companies that are doing well from an ESG standpoint are also then doing well from a traditional credit standpoint. And that's really what the underlying basis of the whole premise of the positives of ESG investing are, is that people who are doing the right things will benefit over the long run. And I would say we have seen that hold true specifically in the corporate bond market, where we're selecting credits under both criteria. What that allows us to do is it allows us to really have the ESG component focused through all of our strategies. Even if a client may not explicitly state that, it tends to show up in a lot of portfolios, because those companies that do well on the ESG, from an ESG standpoint, also do well on a fundamental credit standpoint. It also kind of proves the opposite to be true, that there is, whether you have an ESG bend or not, avoiding companies or entities that do harmful things is better for everyone from both a social standpoint as well as an investment return standpoint. So the example there would be if you have a corporation that's getting dinged for, let's say, corporate governance, and their name keeps showing up in the headlines for lawsuits or negative press of any kind, eventually that's going to have a negative impact on their financial performance, and therefore the pricing of their corresponding bonds will suffer. So whether you're avoiding that because you don't like the credit fundamentals, or whether you're avoiding that from the negative ESG standpoint, either way, the investor is benefiting from that. So what we're finding is there actually is a lot of overlap between applying the ESG screen and just doing strong fundamental credit research on corporate bonds in general. So I think that's, well, if that's a difficult question to quantify, I think that's a very important discussion point to talk about in a forum such as this, where we have not seen people give up necessarily upside or total return prospects as they focus or shift to ESG. The other challenge we see, and we've dealt with, is different pools of money have a better fit for the transition to ESG. And what I mean by that is, if you go back to the discussion of operating funds versus endowment funds, operating funds tend to be very short-term investments in nature. Generally, they have a more of kind of a 1 to 3 year investment horizon. So there's far more natural turnover occurring in that short-term investment strategy. So the transition there can naturally happen more quickly than in something like an endowment, where the duration of those securities or the outlook of those investments tends to be much longer, as much as 15 or 20 years out, we've seen in some cases. So the natural attrition rate there is much lower, and a transition occurs much more slowly on something like the endowment side as opposed to those short-term operating funds. And I think the example was given where some of the participants in this call have echoed that and have kind of gone down that road as well, because any progress in this area should be viewed as positive and should help build towards further widespread conversion and transition. So we've had that conversation with several of our clients is, start small, work towards something bigger, and that has worked quite well. From a mechanical standpoint, one of the other conversations we're often involved in is how do you reflect an ESG mandate in an investment policy statement? And that there's definitely that's more of an art than a science, because it's difficult to quantify. The use of the HIP investor ratings has absolutely helped us quantify it, but there's still some interpretation of what target level of scoring becomes enough to call something ESG positive. And traditionally, the 50 percentile rating has kind of been the starting point for that conversation, with the thought process being anything above the 50th percentile is having a positive impact, anything below the 50th percentile is having a negative impact. And certainly when we've spent a lot of time talking about green bonds, and green bonds are a pretty clear case. Generally speaking, if something's issued for green purposes, it's going to have a very positive or high percentile score on the ESG perspective. But in our portfolios, we use much more than green bonds. So green bonds are certainly a key piece of the strategy, and certainly are let's say, the most obvious way to approach an ESG goal. However, there's many more companies out there that are doing good things and making a lot of progress on the ESG principles that just haven't issued green bonds yet or don't plan to issue green bonds. And we absolutely want to find a way to incorporate those companies or those issuers into our investment strategies, and that's where the thorough HIP scoring that we use for allows us to do that. It allows us to very easily compare corporation A to corporation B, and oftentimes you'll find that one has a much higher level of commitment towards ESG principles than the other, and then that certainly helps aid our decision from a security selection perspective in those client accounts that have chosen to take an ESG focus. Nicole, that's kind of the summary points I wanted to cover. I'd be very happy to answer any specific questions related to transition or guidelines if any participants have them.
Fantastic. Thank you so much, Dominic. And being conscious of time, I think maybe I'd just like to turn this back and open it up to Chris and Kevin as well to respond to the roadblocks that David laid out to endowments pursuing this approach, which were, as a reminder, how will return be impacted when transitioning the portfolio? What is the transaction cost? And addressing the learning curve of board members on SRI and ESG.
Okay, so this is Chris. So thank you very much indeed for that, and thank you everyone for your presentations, which were very informative indeed. So just on these roadblocks, as you said, we are a little bit short of time, so I won't take too long. But just on the returns issue, I think it was touched on earlier by Kevin that there was a slide on the excess returns comparing the green bond index with the global ag, and it was clear that there wasn't that much difference. I would also add that also that with green bonds, the credit rating is often the same for the green bond compared to the conventional bond. So yeah, the return should be the same there. Just on non-financial expertise, I think this is one of the attractive aspects of green bonds. It's the actual narrative. People are not excited often by government bonds or other types of securities, but once they hear what a green bond does, what the money's being used for, then people often sit up with receiving inquiries here. It used to be about the projects, the types of projects like renewable energy and water sustainability. Now our clients are asking much more detailed questions with regards to, where are these projects, in which country, what is the size, how old are they, etc., etc. So they want a lot more detail. So that's one of the interesting aspects to green bonds. And earlier there was a question that was raised about the impact of the current administration in Washington. And I would say that certainly in Europe and in China, they're continuing to move ahead, with the positive outlook on sustainability and the Paris Agreement. And we've been encouraged really by what we've been hearing in the US with regards to various states and elsewhere, that they are also moving ahead in wanting to become more sustainable too. And finally, I'll just add that one of the positive elements, I think, of a green bond is that often the actual recourse for the investor is the balance sheet of the issuer. It was, in some cases, that we had secured issues, and there were concerns that if there was a reduction in government subsidies, for example, then that might impact the return of the security. But green bonds have been very deliberately structured so that the recourse for the investor is often the balance sheet of the issuer. So the risk to the investor is not necessarily the actual outcome of the project that's being funded. The investor still has recourse to the balance sheet of the issuer. So I think there's some sort of reassurance there as well.
Yeah, thanks, Chris. That actually was a really good explanation. But I just kind of want to add a little bit onto that. And yeah, kind of talking about the returns issues. Yeah, as Chris said, I had a slide that kind of compared the global ag versus the green bond index, and it's very similar in risk and returns. And really, in the end, a lot of the types of investors that we do see is, we have the typical integration of ESG factors for their fundamental analysis, and then you have the impact type of investors. So some of these investors are really focusing on the positive impacts, as I mentioned, universities with their green buildings, and also kind of supranationals, municipal sovereigns, focusing on kind of their local regions that, water efficiency, public transport, roads, infrastructures, things like that. So green bonds really have a good effect, and rather than, having an excess return, it's still a stable, similar risk profile. One thing to note also is, there are a lot of issuances of green bonds that are a little bit smaller. And one thing we did update, and it's also in the appendix of my presentation, that we updated recently the Canadian minimum amount. It used to be 300 million Canadian dollars for a bond issuance. We reduced it to 150, just so we can include more different types of bonds out there and not exclude anyone really. And also we did include Indonesian rupiah also as a currency. And when it comes to the administration, as Chris was saying, I don't really see too much affected at this point. Really, in the end, people are really craving for green bonds. There is an excess demand, but not enough supply at this point. It's not growing to the, the 29 trillion I mentioned earlier that needs to meet the 2-degree initiative. And in Chris's slide, it shows that it's a little less than 100 billion at this point issuance this year, but expected to continue growing. And there's just so much more demand than supply at this point. But yeah. And back to you, Nicole. Or anyone else?
Well, we are out of time, but thank you so much for your answers to that question, and to Chris, Kevin, Elizabeth, David, and Dominic for a great discussion and presentations. And also thank you to all of our participants for joining us this afternoon. If you have any questions about this webinar, the work of our panelists, or activities happening in the Intentional Endowments Network, please do be in touch. And again, this webinar will be up on our website shortly. Thank you all again, and have a great afternoon.